I was in Nashville last week. We stayed at a Airbnb in a community, a little neighborhood full of homes that were built and bought to be short-term rentals. And you could tell that it was funny. You could tell that they were all, rentals because they all had the same like light up sign that said Nashville on the walls. The neighborhood's close to downtown. It's really convenient. Nashville is such a growth market. It's like fun to be there. It's an exciting town, but it was really striking to me what happens to the incomplete construction in this neighborhood. There's some that are halfway done, and there are some that look complete, but look like they've never been occupied. What happens to this boom in a 7% mortgage market? In a world where tourist travel slows way down in a recession. Like, I expect that the owner of the Airbnb where we stayed made great money. They're locked into a super cheap mortgage, and the short-term rental fees are plenty to cover the costs. Like, I bet it was a really good deal, but is that sustainable? And what happens to all the others in the neighborhood? What happens? There are literally dozens of cranes building high rises in Nashville. It looks like Miami in the 90s. And what happens to those $1 million condos that are in construction right now in a 7% mortgage world? 7% rates are so different from what we've had for so long. It seems to me that there are just a ton of unforeseen consequences, and not just a little slowing of the housing market, but like all kinds of things that are assumptions that are getting rewritten. So that's kind of the theme of what we're reviewing today, what we can see happening in the data right now and what might happen in the future. If you don't know me, I'm Mike Simonsen. I'm the CEO of Altos Research. And at Altos, we track every home for sale in the country every week. We track all the pricing, all the changes in the supply and demand, and we bubble up those analytics so that you can see what's happening before you see it in the traditional headlines. And things are happening kind of crazy right now. In the call today, like I mentioned, we're gonna spend a little time like trying to understand what we can see happening. Mortgage rates spiked in the last 5-6 weeks. They are up again today with the latest inflation numbers. What happens with rates over 7%? We're looking at inventory trends, what's happening right now, and what's likely to happen for next year, what we can see happening for next year. The home prices, same thing, like what's happening with prices right now and what's happening next year. We always try to frame with how to talk to buyers and sellers about the data right now. And because things are so striking, and everybody knows craziness is happening in all the markets, people are afraid. They have opinions about what's happening. Maybe they're reading about what's happening in Austin or Phoenix, and they think it's happening in their neighborhood in New Jersey. Those kinds of things are how we use the data to better communicate with our buyers and sellers. And it's really the data that's going to help us get past those fears. So that's why we're doing it today. There are local markets behaving very differently from each other right now. So it is not the same conversation across the whole country. There are plenty of markets that are significantly slowed. In fact, the big boom markets, and I'll try to show different local markets. I'm going to show us both in things like the price reductions, and then we'll dive in and do some of the local market deep dives as best we can at the second half. By the way, when I talk about the data and how we show the data in the Altos reports and the Altos systems, if you need to learn how to use the data to communicate with buyers and sellers, go to the Altos Research, go to the link here. And by the way, in the chat, Lael and Jeff from the Altos team are in the chat. And so anytime if I share a link like this for the ebook, you can go into the chat, click the link that they are sharing there. And they'll be able to answer questions along the way as we're doing looking at the data as well. So use the chat. Lael and Jeff from the team are there. So if you need to look at your local market, I may not be able, I can't get to all of them today, but I'll try to get to as many things as I can. Go to altosresearch.com, book time with our team, look at your local markets. You can see how the data is changing right now for your buyers and sellers. And it's a really important time to get the data into their hands. So that's why we're here for you. Okay, let's start today with mortgage rates. Mortgage rates spiking over 7%. You can see the chart here is each color is a year. And so we're going back over a decade. And you can see the middle of the chart in 2018, we had a climbing mortgage rates, spiked to about 4.9%. And we watched the market slow in 2019. We had a little more inventory. And we had prices that were price appreciation slowed way down into 2020. At the far right end of the chart here, the brown line that's this year. And of course, it's been remarkable. Spiking to 7% was way higher than anything that I had in any of my assumption earlier in the year. So it's hard to forecast like what's going to happen to inventory when rates climb, but rates climbing to 7 is way outside of what I had any ability to envision. What we can see here, and this is important when thinking about 2023, thinking about next year, rates have spiked over 7%. Things are like mortgages are significantly 80% more expensive than they were a year ago for the same cost. And like that has just massive implications. What we do know though, is this little stretch in the middle here where the rates went back down. They went back down to about 5%. This was August and September, or July and August, they started falling down. At the beginning of September, rates started spiking back up. And when rates were around 5% in that August time frame, what we could see was that people were buying homes. The market was moving. It was slower. There were places that had been the most hot, had certainly slowed down. Buyers had cooled way off. Price reductions were climbing, but the market was moving. After the first week of September, that's the last little big spike up there in rates, and now buyers have stopped cold. And so the thing to keep in mind is when you're trying to understand the consumer threshold for 2023, for example, if rates stay here at 7%, that's a bearish sign for pricing, for transaction volume. All of the things in the market have to take a significant slowdown. If rates ease back down into the 5% range, my expectation is that you'll see people doing transactions. Like it doesn't have to go back down to 3. We could see the action happening at around 5 to 5.5, but over 5.5, things stop cold. And so, we're in areas where I was unable to see it coming. And I don't have any ability at Altos. We don't do any forecasting of mortgage rates. I don't know where they're going to go. I don't know if they go up from here, if they go down, if they stay the same. But what we can see is in that 5.5% range, the transactions were happening. People were still figuring their things out. And then when rates spiked above 5.5, is we saw a dramatic slowdown at the first week of September when that happened. And so that's the thing to keep in mind here when we look at 2023. And here's how we can see it. This is a chart of inventory, available inventory of homes for sale. These are single family homes across multiple years. And this week, inventory is at 561,000 homes. It is unchanged from last week. But inventory has started climbing, and it probably will climb another couple of weeks at least, because as rates spiked from 5.5 over 5.5, buyers stopped cold. And even though the new listing volume is very low, the transaction volume is even lower. And so inventory is building. And I'll show you in a sec where that plays out. So inventory is significantly higher than last year at this time, 561 versus 425. And just now more than it was in 2020 when the pandemic was kicking in. And you can see the trend there, 555,000 when the pandemic was starting. Inventory was just falling every week. Rates were falling, people were buying, people had the cash, the mortgage rates were low, and so people were buying everything in sight. So what's fascinating, though, is that inventory is still 40% lower than normal, than 2019. And if you can look back here at the far right end, or far left end of the chart over here, you can see inventory is 1.2 million single family homes on the market at a given time in 2015. So what happens for next year? Well, let's look at inventory for the rest of the year, and then we'll talk about what happens beyond. In our weekly forecast of inventory, we have each color here is a year, and the bars above the line are weeks when inventory grew, below the line weeks when inventory shrank. We're at the last few months of the year. Typically, there's very few new listings. The stuff that's on the market gets bought or withdrawn, and inventory falls through the rest of the year. In our forecast, we can expect inventory will probably grow next week, maybe the week after. If inventory is growing into November, that would be really unusual and really bearish signal for transactions that haven't happened yet. It'll show that people have stopped cold, buyers have stopped cold, and that then is bearish for pricing. That the homes that are on the market have to take price cuts. The ones that are thinking about listing come in lower because they can see that they need to do some kind of discounting to get some demand happening. And so in the next few weeks, I would expect at least one more week of inventory to rise, but if it's into November, like, that's going to be a real signal to keep our eyes on. And here's what the forecast looks like. So each line here is a year, and the dots, the dotted part are the rest of this year. Now, it's really hard to imagine inventory rising in November and December, because who sells their house at that time? There's only, very few people list their house at that time. And so, and there's no signal of any flood of new listings hitting the market. And in fact, when we look at August and September, and you can see there's a little at the first week of September, there's a little V in the dark red line. And that's because that's when rates spiked and inventory started climbing again. Inventory had plateaued and started falling. And what was happening is sellers, homeowners in this country, all have super low mortgages, so super low costs locked in forever. They have, and they have their equity. And they have their jobs. So we have record employment levels right now. And so there's no pressure for sellers to sell. And so we're in this, I've called it a tug of war. There's no pressure for sellers to sell. So there's very few new listings in the market. But of course, at 7% mortgage rates, it's really expensive for buyers to buy. And so it's a tug of war. And it's going to be really fascinating to see what happens, who wins the tug of war. In 2023, the factors that could lead to us getting inventory back to those normal levels, the higher levels here, you can see that normal, might be 850,000 at the end of the year. This year, we're going to end under 500. So what happens in 2023 that might get us there? There would be things that would have to essentially push sellers to come to the market. Some things that could happen. Well, if recession hits big, we have big job losses. That is likely to be 2024 before we see significant inventory, simply because of how long it takes. You lose your job, then you're worried for 3 months, and now it doesn't look like you're going to get another job. And then you have to stop paying your mortgage. And then you have another 90 days or more of that scenario before you even start talking to the bank. So it's at least 6, 9, 12 months before you see anything after the job losses start. So job losses per se, would be adding inventory in 2024, more likely. What if there are the big investors whose cost of money changes, and those folks need to want to liquidate some of their holdings? So then you could imagine, like I opened with the conversation about Nashville, and I'm in this Airbnb in Nashville. Is a house that was purchased, never lived in. It was bought to be a short-term rental, and all the neighbors are short-term rentals too. And so you could imagine places like that in Nashville and Austin and some of the Phoenix, some of these places that have strong tourism and have had super strong growth. Like these, you can imagine that these places, some of those investors get spooked or get into other binds where they need to raise cash, so that those could add to inventory in the next year. And maybe that helps us go from 500,000, maybe we get to 600,000 or 700,000. The other thing that happens when rates rise, the reason inventory has been falling every year for a decade is because being an investor has been a really good opportunity. And we've turned 8 million single family homes from resale into investment rentals. So as rates rise on my next purchase, the cost of being a rental property is much higher. And as rents start to tick down, that deal gets to be less exciting. So instead of keeping that home as a rental property, I now list it for sale. And so this is why inventory rose. And this is the dark blue line here. Inventory rose in 2018 as rates were rising, because each of those deals becomes more expensive. So we're going to get inventory rise in 2023. Next year, it's going to rise. You could imagine that we go from 500,000 to maybe 600,000 or 700,000 by the end of the year. It sure is hard for me to imagine we get close to normal, back to that million home range that we had a few years ago, because so many Americans have such a good deal that there's very little incentive to sell. But if rates stay multi-year there, then we work our way over time back to that more normal inventory level. Let's switch to what I talk about as the immediate sales phenomenon. During the pandemic, the defining characteristic of the housing boom was this immediate sales. These were homes that get listed and they get offers and they go into contract in hours or, a couple days right after listing. And what we can see here is that each bar here is the new inventory plus the new inventory that went into contract immediately, the immediate sales. And so the light colored portion are the immediate sales each week. And it was really surprising to me how high that stayed pretty late in the year, even after mortgage rates were rising. So the the light portion started to shrink, but now it is. So at the far right end of the chart, you can see the light portion of the bar is really small, and it's smaller than it has been any time since the January 1st week when nobody does anything. So that's going to keep falling. And this is it's so the you can like see that we're finally getting like eliminating these, getting back to a normal set of immediate sales. The other thing that you really notice in this chart is the dramatic drop in new listings after the 4th of July. You can see that the second hump here like has this big drop, and it never regained. And so this is late summer. This is sellers who are saying, I don't have to sell. If I wanted to sell in this year, 2022, actually the demand was pulled, or the supply was pulled forward into April and May and June, because you could see that the market was probably going to get colder from there. So then all of a sudden in July, fewer listings. And so this is the tug of war, right? You can see that there's no immediate sales, demand's way down, but we have sellers who are perfectly happy to not sell. And that's going to continue through the year. And this is how it looks when we're looking at the new listings each week. This is single family homes. So these are not including those immediate sales. These are like new listings that stay on the market. The dark red line is this year. And you can see earlier in the year, and the light red line is last year. Earlier in the year, because we had all those immediate sales, like those things aren't on the market. Like those are gone. And so that was keeping that inventory level down because people were buying them so fast. Now we have the dark red line then moves out here towards later in the year, and we have fewer new listings each week than we've had in any recent year. And that's not because people are buying them, right? It's because sellers aren't selling. And that implies that it keeps a cap on our inventory. It implies we keeps a cap on our transaction volume. And it also implies that we have less downside pressure on pricing than you might expect for this side of a cycle. Like the 2008 cycle, when people stopped buying, we also had people start selling. So we had the double side of that sword, and prices had to collapse down. And so we've only got one side of it right now. And it seems unlikely that we're going to get a surge, but we will have to imagine more listing volume in the next year as a few of these other conditions change. Okay, let's talk pricing. So median home price in the US, single family home, is $434,000 this week. It's down a little bit from last week. And this time of year, home prices decline normally through the end of the year. And then they reset the second week of January and start climbing up for the spring buying season. Last year at this time, median home price was $389. And you can see each of the little curves for each year going back a bunch of years. The thing to notice right now is that home prices are declining. They are declining pretty quickly, but not in a scary way. So the unusual part, last 2 years, where home prices didn't really decline much in the fall, like people were buying late into the year, both of those years. And that's not happening now. So home prices peaked June 30th, and they ticked back down. June 30th is a common place for home prices to peak for the year. The light colored line here is the median price of the newly listed cohort. So each week homes get listed for sale, and the pricing of those is really a leading indicator for the whole market. The sellers and listing agents, when you go to price that initial listing, like, you know exactly where the demand is, you know how many people are at the open house, you know if there's offers on the ones that are on the market now, you know those if there's no offers and there's price cuts happening, you do a little discount. And so the light red line is pulled way back. And this one's going to be really important to watch in the second half of January. I like watching it there because then we can see the reset on the market, the new stuff coming on, the best stuff of the year starts coming on, and we can watch how steep and how quickly that line climbs. So you can see the light red line, last year's dip, and then jumped up. It jumped above the dark red line. It was really strong. And like at the beginning of this year, it was as hot as it could get. And you could see it in that line really fast. So what this is telling us right now is that in the sort of the best scenario for 2023 is that we're looking at flat home prices year over year. And the best scenario means like you imagine mortgage rates coming down a little bit, people not losing their jobs, like keeping the momentum and the conditions sort of as we can see them now. If we get bigger recession, we get mortgage rates spiking, or more inflation, things like those kind of chaos, then you can very much see how the home prices have to discount further from here to make those things make sense. And it's kind of fascinating because across the country, nationally, home prices haven't really discounted very much yet. The median price on this chart will be closer to 400,000 at the end of the year. That'll be normal. That'd be a 10% gain over the end of 2021, like which is already baked into the data. Because it was such a strong first half of the year, but next year is going to be flat at best based on what we can see now. Okay, let's talk price reductions. The 41.9% of the homes on the market have taken a price cut now. That's pretty high. A normal range is about 35% of the homes taking a price cut. And so you can see the yearly curves here. And then this year, like being ultra low and now slowing dramatically down. There's a couple of points that I like to point out here. 2018 was the last time we had rates rising. Rates rose from 3.9 to 4.9%. And you can see price reductions climbed from the low point up to 37.1. So that was the peak of price reductions. And it was this week in 2018, like mid-October, is when price reductions typically peak. And then they start resetting for the year. Like homes get sold or they get withdrawn, and so fewer price reductions. What we can see right now is that home price reductions have not yet peaked. They haven't really flattened. And I thought they were going to in August, but then when rates spiked again, price reductions started spiking again. So that week of that first week of September, mortgages spiked 5.5 to closer to 6. The market stopped. Price reductions kicked back in, and so this is pretty bearish for home prices into next year. And really, the message here is, for buyers and sellers who say, how's the market? What we can see is that people who have their homes on the market now are probably a lot of those are going to probably have to take price cuts before they sell. We can see that mortgage rates at 7% have taken demand way out of the market. And so anybody who's sitting on the market now at this unfortunate moment is probably going to have to take a price cut. And it's really unusual for October, late October. The other thing that's going to happen is that a lot of those sellers are going to simply withdraw their homes from the market. And that'll ultimately be what gives us a peak on our price reductions. It'll start curving back down because they just won't be on the market. If they're like, we did 2 price cuts and we still have no offers, we're taking the house off the market. And we take it off for the holidays anyway. Maybe we try again next in January after the holidays. And that'll start happening. But if price reductions climb, above 42, 43, 44, like that's starting to get really bearish for transactions that haven't happened yet. And then my suspicion is that like this is going to be very much tied to that threshold of mortgage rates at about 5.5%. If rates stay up at 7, like there's a lot of adjustment to happen still. If they come back down, now the payments are easier. More people are willing to do their transactions in that range, as evidenced by July and on August this year. Let's do a switch to look at price reductions in different markets across the country. So I have the Altos Advanced Analytics dashboard up. I have a ranking of the top 50 price reduction markets around the country. And if you've been on those videos before, the webinars, these markets are there. The rank hasn't changed much. Boise was, the hottest. Boise, Phoenix, Austin, and the Utah markets, the hottest boom markets during the pandemic. And these are like big inbound immigration, and people who are, when rates are 3%, I can overbid without blinking because my payment doesn't change very much. When rates are 7%, I can no longer do that. I am very price sensitive at the margins. And so in places like Boise, excuse me, with that, where you had a lot of inbound California purchases, like those had to stop. Boise's now at 63% of the market has had a price reduction. The Phoenix is at 62%. And so these are really bearish for transactions that haven't happened yet. Like there's simply demand has simply slowed way down. You could see the Utah markets, Denver. The other thing that's interesting now is that since that first weekend of September, when rates spiked back up that 5.5 threshold, you can see all these markets who are now over 50% with price reductions, and a whole bunch more very close to 50. So you can see how that's happened, and we'll dive down and you can see that like we thought it had plateaued, but then in the last few weeks has started climbing again because demand has stopped very cold. And you got to imagine this week rates spike again over 7%. That's gonna, like, for existing home sellers, that's gonna like put a damper on things for sure. We'll come back and do some of the more local markets in just a sec. All right, on to pendings. The pendings number of homes in pending contract is 36% fewer than last year at this time. The dark bars here are the total count in pending in any given week, and what you can see is how it's fallen off pretty dramatically this since the middle of the summer. The other thing is, during this pandemic boom, we had more homes in contract than we did on the market. The light bar is the actual active inventory. That's starting to normalize. Like, that was super weird. It's starting to normalize now where inventory is higher, transaction volume is lower, but with only 358,000 single family homes in contract, like that's one of the big things that's where you can see for next year is how many fewer transactions there are in store. Even if, prices don't crater very far, like there's sellers is still going to be not want to sell, and buyers are not going to want to buy. We have that tug of war. And so the transaction volume is significantly lower and falling very quickly. Okay. On to relisting. So one of the phenomenons that happens is that you have a home that's gets an offer, it goes into contract, and it like if that contract fails, the funding fails, the buyer gets cold feet, that gets relisted. And or if there's no offers and it gets withdrawn and then relisted, we'll track it as a relist there. You can see here what's interesting is that the left end of the chart, the spikes, the relisting spikes after the holidays, right? Things get pulled over the holidays and then relisted. They didn't spike much in the last couple of years because people were simply buying straight through the holidays. Next year, you're going to have a big spike after the holidays. We'll see who gets relisted. What's interesting here is that they're not climbing. Relists are not climbing as much as I would have expected. What's happening, I suspect, is that the contracts that are falling through, those homes, many of those homes are simply not getting relisted, just being withdrawn. And so we have, more relists than we had in recent years. And it's generally climbing, but it actually hasn't spiked very high yet. And my suspicion is because those are simply being withdrawn. And so, but if we watch relists climb, like that's going to be another bearish signal for the market. So this is, again, a little bit of that tug of war between buyers and sellers. Sellers going, wow, well, that failed. I guess I'm not going to sell. And so it's not just buyers backing off, it's sellers saying, I don't have to sell either. When we look at those relists as a percent of the pendings, now though you can see significant increase in the rate of things like contracts failing. So, there's fewer homes pending and still a lot of relists going. And so, very few in the spring, only 5% of the homes were getting relisted once they were in contract because they have backup offers and all kinds of reasons. But now that is growing significantly pretty quickly, and it'll be really fascinating to watch where this settles in during the next year. Days on market is climbing, but it's climbing off such record lows that it's really hard. Like, you can't have, there's no houses on the market for 180 days because 180 days ago, people were buying them super quickly. So those the market time is starting to get back to normal, about a month and a half right now. Last year was still only, 30 days, 1 month. Normally though, in September, October, it'd be like 2 months would be an expectation. And so we're starting to normalize there. And it's one of the reasons I suspect that sellers are not like super panicky yet, because they're not looking down the street and saying that the neighbor's house is on the market for 6 months, because it hadn't been 6 months. So we're still pretty early in the cycle, but that's going to climb back up for next year. I do like to look, especially at days on market, in the price range segments. In your Altos reports, the price ranges, there's 4 price ranges for every market segment, every market, every report you look at. So the high end of the market may be behaving very differently from the low end. And I'll show you a couple of these in just a minute. And if you need to look at your local markets, you're saying, Mike, I want to let's look at my local market. And I don't get it today. Go to altosresearch.com, book time with our team. And so you can then look at your local markets, see which of the price points are the ones that are moving, the ones that are slow. Across the country right now, this $350,000 to $400,000 price point is really the highest demand. And that's where investors like to be. That's where home buyers like to be. And what's going to be fascinating is at 7% mortgage rates, does that drive that demand, demand threshold down? We can see that at the $1 million range, it's already taking 2 months. Like market time is climbing dramatically at the high end of the market. And at the low end is slowing, but still you can see faster turnover. So when you get your Altos reports, look at the market segments, because when you're talking with a client, a buyer or seller, if their perception is that, it's slowing and they're looking at the high price point, but in their price point, there's actually some demand, like that's a meaningful change that they need to understand. And that's why we do the price segments, because the high end of the market may be behaving very differently from the low end. One last data point, then we're going to do some local. And this is rents. Rents have begun to decline. The dark red line is rents of single family homes. And one of the reasons that we could justify affordability challenges. Home prices could be higher because rents were higher. You could get more income from them. But we can see weekly declines in rents right now, and so that is a significant implication for home prices in the next year. Okay, as I mentioned, you can go to Altos and get the ebook to go look through all these the data that I discuss, how we discuss it, ideas and scripts, strategies for communicating with buyers and sellers with the data. It's a free ebook. Go to that link. It'll be in the chat. You can go click there and get that ebook to help you use the data in your conversation. All right, now we're switching over to market reports, local reports. Austin is one of the, so this is the Austin report. And I wanted to look at inventory in Austin because Austin is one of the 3 or 4 of the hardest hit markets. Austin, massive inbound immigration from California, and as rates jump, it's significantly harder to support the prices that Austin had. So sellers built. What I wanted to point out here was inventory climbed highest it's been in years. Although if you look back to 2017, 2018, it's not actually that high yet. However, we can see this here's September 9th, and then inventory starts climbing again. In fact, let me turn off this one. So you can see this little dip. Inventory had plateaued when rates were in the 5s. And then rates jumped over 6 and inventory started climbing again. And now they're at 7. So you could see how sensitive Austin is to that that mortgage rate threshold that I've been talking about. And we can see it's across the board here. Nothing's jumping out in terms of price points in Austin. But let's look at Boise. Boise has also this case where inventory rose dramatically during the first half of the year, and then plateaued a bit after when rates did in July and August. We can see in Boise, though, the only place it's moving here is now under that $400,000 range, that $350,000 to $400,000 price point, and how dramatically slowing the high end at Boise is. That's a real implication. Boise is our percentage, with price reductions. So normally Boise is a 40% price reduction market. And we can see that we're at 62.5 and climbing. So this is really what shows us how slow Boise is. And Boise is, one of what we call the Zoom towns. We can look, in fact, I have Truckee, California, where a lot of the San Francisco people moved, or Bend, Oregon. And we can see how those markets have moved way back down into buyers territory, from being this off the chart sellers markets, slowed way back down in the last few months. Here's a contrast, though. Let's look at Morris County, New Jersey. And in Morris County, New Jersey, I have inventory. Look at the inventory trends here. The inventory has not really come back up. And this tends to be true in the places like Chicago and Cleveland and so New Jersey and the Northeast. What's happening is that the markets that are doing the Austins, Boise's, Nashville's had a lot of inbound migration that was gobbling up all the supply. That migration slows way down. Those overbidding opportunities slow way down, and therefore inventory builds. But that immigration was never driving Morris County, New Jersey. And so significantly slower inventory change than in the other parts of the country. Really a fascinating difference. However, look at this. Look at our days on market at the high end in Morris County versus that. Here's that price point, 350 to 3 to 400. That's where the demand is. You can see it exactly happening there. I have Nashville I have Nashville. I have Nashville open. I have Orange County open also. Orange County, California is open because it's kind of in the middle. We can see that Orange County had dramatically fewer homes for sale than normal, 5,000, even 3 years ago. Then down this spring, 700 homes. Like people were still gobbling up everything. Um, a lot fewer, but we know that the sellers in Orange County have locked into their ultra low rates, so they're not in a dramatic urgency to sell. So inventory peaked and maybe will start climbing a little bit, but Orange County wasn't really driven by a lot of migration coming in. Orange County does have international buyers, which it probably still driving a fair amount of that level of demand in Orange County. And in Orange County, you can see the lowest price point with the fastest time on market again. Let's look at a couple others. I have Florida up here. Inventory in Florida did a dramatic rise. And in fact, I was interested in particular in the hurricane markets. So Fort Myers, Tampa, and Orlando. And the way you can really see it, I'm going to go back over to our advanced analytics here, and I put a little widget up. Here's Fort Myers, Tampa, and Orlando. And this is the new listings in a given week. And what you can see is this is how the hurricane impacted. So 300, 400 new homes listed per week. And then last week, boop, almost none. 32 got in there somehow. In Tampa, 3, 4, 5, 6, 700. And then last week, boop, down to 300. Orlando, same thing, and down to 157. So that was really where we can see the hurricane. So the new listings that simply stopped at that point, which is keeping a cap on Florida inventory growth. So we have maybe just a few hundred fewer last week, or maybe 1,000 fewer homes on the market last week because of the hurricane. And like, there's still a lot of implications to carry that, especially in that Fort Myers market, some of those Fort Myers areas like Sanibel Island. And then again, in Florida, we can see market time climbing dramatically for anything over $1 million. And then just for kicks, we'll finish up here today. Leander, Texas. Leander, Texas is the market that has the most homes for the zip code that has the most homes for sale in the country. And we can look at the inventory here. And so we can see inventory climbing from way above where it was, but still actually not where it has been in the past. And we can see up here, or let's look at the price reductions here. And you can see how dramatically, here's our, starting at the beginning of September, price reductions are climbing dramatically. 71% of the homes in Leander, Texas have had a price reduction, 72%. Like there's a lot of change to happen there. And if we look at what's happened with pricing already, we can see, how dramatic price appreciation was. We're back down. We're not back down to where we were even a couple of years ago, but you got to expect that that's coming. That adjustment is coming way back down. We're a little bit higher than last year at this time. Some of the boom towns like Truckee, the Zoom towns like Truckee, their home prices are back down to where they were 2 years ago. Median price on the market. Really a fascinating time. Okay, let me switch back. Those are the time. As I said, we don't have time, of course, to go into all of the local markets. But if you want to go dive into your local markets, we have every zip code in the country. Go to Altos Research, book time with our team, go get your local reports. You can see it there and understand, like if you're in Leander, Texas, like that's a big deal. That's a significantly different than being in Morris, New Jersey right now. And That's really what I wanted to leave you with today. We know that 7% is like, I didn't have it anywhere in my view. And we can see when rates jumped over 5.5, buyers stopped cold. So if rates are staying there, that has big implications for 2023. If they start receding back down, now all of a sudden that, buyers can see how to make deals happen, and there's some significant opportunity there. But I don't have ability to predict rates, so I don't know where rates will be. So those things, we'll just have to watch them as they happen. So that's all we have time for this month. Thank you so much for attending. We look forward to seeing you in person, and we will, and we'll see you again on the weekly call, the weekly videos next week. All right, everybody. Thanks so much.